everybody, and thanks for joining me today on our Prescient on Point Live. This edition, I've asked our CIO, Bastian, to join us. Welcome, Bastian.
Thanks for having
Thanks
me,
for
Murray.
thanks for doing this with me. Bastian, as a systematic house, Prescient Investment Management, we have a top-down view of the world, and we bring into our investment process lots of data and computational power, and we talk about being evidence-based. So from a global macro standpoint, maybe just share with the audience how we start that process. And I think what we'll do is get into a little bit more detail around some of the tools that we use.
Yeah, 100%, Murray. Thanks again for having me on your webinar. I think the most important part is always to start with the US economy. Sometimes we get the criticism, why are you only speaking about the US? Well, because we are data-driven, and the data shows that's where everything starts, right? So with that, we have to speak about that a lot. What do we know about the US economy right now? We think the US economy is growing at roughly 1.78, just checked it out this morning, 1.78% in real time, which is like below trend growth, but it's certainly not collapsing. It's certainly not booming. So it's not the most exciting story, but it in itself tells you something. It tells you that the US economy is very resilient. It's stronger than what we thought. Definitely can handle the current oil crisis very well. And I guess in that itself lies quite a bit of messaging. Having said that, the true, more interesting story, I think, is more in the underlying inflationary trend.
Bastian, it's quite interesting how you get to an accurate number like that. Please tell us how you derive a number of 1.87.
Okay, so we derived that through our own in-house nowcasting. So basically every day we take roughly 150 data series, which we drill into the last detail and then basically attribute on how good they've been in the past to explain the pace of the US economy. And that obviously hasn't always been perfect, but it does a good job, and we can measure the quality of that job. And the quality of that job is roughly 76%. So we know in real time, as we speak, with a 76% degree of accuracy, how fast that economy is growing. So that 1.87 is only by 76% accurate, but accurate enough for us, and it's important to understand the trend.
Okay, so if I think of that and just put it in different terms, is one could take the data points that are published and say, okay, well, that's what GDP is, or economic growth in the US. Or you can go and recalculate it and say, is it right? And so the nowcast that we do takes 150 data points, which is quite significant, and is calculating it as of today. So it's got updated data points. You're not relying on historical data and potentially some revision that may come out of the Statistical Bureau in the US.
That's exactly right. 150 data series. So data points obviously much more, but you spot on exactly the way you described it.
Okay, great. I mean, obviously what that does is then gives us a fairly accurate view, because that has an impact on interest rates, and particularly obviously what's happening with inflation, and then where's the likelihood for interest rates, what's the path it will follow.
100%, and I think the inflationary trend right now is really the interesting bit. So on the US economy, we'll say it ticks along, it's fine, it's doing what it's supposed to do. But on inflation, that's where we really disagree with what the market is pricing and what the headlines are suggesting. So looking into inflation, we really think that it's not going to be a problem. We're in the same scenario actually as we've been during the trade wars, where it's this short-term once-off shock from a supply side. I mean, the oil price spiking, it's like the textbook example of supply-side driven inflation, which you should not react to with monetary policy, which means you should look through that. And that's what we agree with.
So the whole question around whether interest rates in the US are going to remain high or increase, I mean, obviously that has an influence on pricing assets. Obviously, what we have to do as an asset manager is make a determination around whether asset prices are accurate at this point and where they will be in the future. So using this tool with a 76% accuracy gives us a lot more confidence, and not just taking historical numbers and at face value.
It is. And obviously the key thing for us is not just to take that print of 1.78 or 1.87, but rather look under the hood in detail. I think the best way is to actually show you some of the components. One good example is to look into the beige book of the Federal Reserve. So I'm not sure if everybody in our audience knows what the beige book is or deals with it every day.
Definitely haven't read the beige book.
So the beige book is basically the Fed calling all the 12 regional Feds, and they ask them, how's your how's your part of the world doing? And the regional feds will then say, yeah, we've got a few trucking companies which don't have orders. We've got a few restaurants where there's no waiters because there's a shortage on the labor market, etc. All of that gets compiled in what we call the beige book. And it's obviously quite sentiment driven, but in our process, the strength is that we can distill that sentiment into hard numbers and actually measure it. So what we're looking here is at our own analysis of the Fed's beige book. This is the July 2026 version, so basically the last one. And what you can see on this spider web is the Fed of that beige book. And you can see whether the chart goes onto the vertexes. So basically further out means the Fed has been positive. Further in means the Fed has been negative. So you can see that on wage price and inflation at the bottom of the chart, that's something which they see as rising. But what you can also see is that they're quite bullish on the labor market and manufacturing, which is something which we don't necessarily agree with. If we just compare that, and that's where it gets interesting, to, let's call it Jan 2026, which is before the crisis, you can see that the red line, that's before the crisis, they were less worried about trade and supply, so that has now shifted in. They were less worried about wage prices and inflation, which is no surprise. But interestingly, they were less optimistic on the economy. So what you can see is that despite the crisis, manufacturing, labor market, even the broad economy here are doing better than what the Fed, than what market participants would think. So the Fed thinks that actually all of these elements are fine. Obviously, there's a lot of information in that for us. If I just take one other snapshot here, and I'm going to go back to June 2025. And if you ask me why June 2025, well, that was the peak of the trade wars. What you can see here is that we had, with all of these tariffs coming in, a similar sentiment on inflation, got a similar sentiment on input costs. We had a similar sentiment on trade and supply. So it resembles the current situation when it comes to trade, input costs, and inflation. But at the same point in time, it was a less optimistic scenario than on manufacturing, labor market, and wage price. So basically trying to say we are in a similar state as we've been during the trade war, supply side driven shock, no long-term issue here. And right now, the US economy is handling that particularly well.
Bastian, that's very interesting. So the beige book kind of is a lead up to what that ultimate decision is, or the indication from the Fed around the direction of interest rates, given this information. So we get to see it because we bring you all of this data in ahead of time, which is amazing. Obviously, then our current view of US rates and inflation, we formulate that, which gives us an indication of where we see asset classes. So in closing, maybe a quick question is around what is our asset class outlook?
Yeah, 100%. So what I just said is that the US economy is doing fine, but it is slowing, but it's doing fine. So that's not necessarily good for growth assets. They want to boom, but it's not necessarily bad for fixed income assets. They want to carry and they will get a lot of carry. At the same point in time, the inflation backdrop is quite optimistic. We said like everybody's worried about inflation. It's in the media, it's in the press, but it's not going to be an issue. So that makes us positive fixed income. So with that, we are quite optimistic on US rates. We think US base rates will come down. The Fed shouldn't be priced for as many hikes as they are. That will come down and revert. The back end of the US curve is too high. That will come down. Translates to South Africa, meaning we shouldn't have those hikes priced in South Africa either. That will come down as well. And the back end of the South African curve is quite elevated because everybody's still pricing us to be quite in trouble because of the inflationary situation, which is also not right. So everything SA quite bullish when it comes to fixed income. Everything global also bullish when it comes to fixed income. Equities cautious because that economic picture is fine, but it's not a boom. And with that, the valuations which we are talking about right now with very, very elevated PE ratios, even in emerging markets, that's something which we don't agree with. So cautious on equities, positive on fixed income, positive on the safer bets, the haven assets, less positive on the spread products. I think that sums it up in a nutshell.
Thanks, Bastian. That's great. And then final question. I always like to ask our guests on this podcast. Tell us something personal about yourself. Is it something you read or some interest that you have that you'd like to share with the audience?
I do read books. Maybe my biggest hobby is probably traveling. Lived half of my life in Europe and traveled a lot across Europe, but now we're in South Africa. And given that we're in South Africa, we still feel like tourists to our own country. So, Murray, you traveled with me. You know, I'm still taking pictures out of the plane. So yeah, traveling, particularly traveling locally in South Africa, is by country mile my biggest hobby.
Fantastic. Bastian, thanks again, and thanks everybody for joining us. I hope you enjoyed this conversation.